My screen is reading managing payroll taxes. That is what we are going to cover today, managing payroll taxes. So in this session, we are going to look at one of the areas where your services are needed, and that is managing payroll taxes. As a tax consultant, tax employee, as a tax agent, tax advisor, your services are needed in the management payroll taxes. So we are going to look at that and how you're going to prepare yourself to service your clients. So in this session, we are going to look at an overview of the payroll taxes that you'll need to manage on behalf of your clients. We are going to look at the legal framework to ensure that you are complying or your client is in compliance. We are going to look at the pay system and then the rates of tax So we shall begin with an overview of the payroll taxes. And of course, as you might be aware, the payroll taxes are those taxes that are deducted from employees' earnings. The taxes deducted from earnings of the employees. So your work is to manage those taxes, including ensuring documentation of those deductions, ensuring correct deductions so that we don't have mistakes, ensuring timely and proper filing of those taxes to URA, ensuring subsequent payment by your client for those taxes, and then also ensuring that the employees from whom these taxes have been deducted have received their tax certificates. So ideally, the taxes we are talking about here include, number one, the payee. Payee is the pay as you earn, which is a personal income tax deducted at source by the employer. That is now your client on behalf of URA. The payee, which is the personal income tax deducted at source by your client, the employer, on behalf of URA. That is number one. Number two is NSSF, which is National Social Security Fund. And these are contributions aimed at providing social security. So again, you'll be managing this, ensuring, as we have mentioned, proper documentation, correct deductions, filing the return, subsequent payment, and so on. We shall also include the planning, okay? You cannot see an opportunity and you don't use it. So most of the clients, as I mentioned, are interested in helping them save taxes. And I hope you have been able to market yourself like that. I'm going to help you save taxes because it is possible to save. There are ways, what we call tax planning. We shall be looking at that. Then number 3, the payroll taxes we are discussing here include LST, which is the local service tax, which is a tax that supports local government funding and services. So again, you're going to be managing this on behalf of your client. You'll be managing the local service tax on behalf of the client. So we are going to exhaust the management of these 3 animals in the house. These are the animals in the house, and we are going to manage them. So our discussion will begin by looking at the legal framework when it comes to the payroll taxes. Accordingly, the relevant laws governing payroll taxes include the Income Tax Act. This one establishes pay as you earn, and the personal income tax obligations. So as a tax employee, tax advisor, tax consultant, you need to know exactly which provisions within this tax law address the payroll taxes. Then number 3, as a relevant law, is the NSSF Act, which mandates contributions for employees in the formal sector. Which mandates contributions for employees in the formal sector. Again, we are going to be looking at these contributions in line with what we have laid down in our training today. Then number 3, the Local Government Act, which sets forth provisions for LST, the local service tax. So all of this is included in our training. We are going to be diving into a deeper discussion on these relevant laws governing the payroll taxes. So as a tax advisor, consultant, or a tax agent, you must have a copy of the current laws, okay? Because you know the amendments keep on happening. We have a very, very vibrant and excited MPs who keep on changing the laws now and then. So you need to be on track and at least have a copy. Okay, just have a copy because you might need to reference to those copies as you're serving your clients. Again, as the framework, there are obligations on the parties involved in this task, the payroll taxes. Here we have the employers. The employers are responsible for accurate payroll deductions, timely filing, and remittance in compliance with the pay system. So these employers are the clients. Now you're going to be hired to help the employers in accurately making these deductions, supporting the timely filing, and of course you will remit these to URA. So we shall be talking about your role here. And then on the part of the employees are entitled to correct deductions and the prompt issue of their tax credit certificates or statements. You remember we talked about this, that how many of you have these certificates? So we are going to talk about this. Then, of course, as we move into our discussion, we look at the pay system. The withholding of tax, as we have seen, is by the employers, your clients. So your clients act on behalf of URA. They have to ensure that they deduct. And according to Section 116 of the Income Tax Act, every employer shall withhold tax from a payment of employment income to an employee as prescribed by the regulations made under Section 164. So you're going to support the employer. The employer is your client. You're going to support them and help them see all of those transactions where deductions must be made so that they comply with the relevant laws of Uganda. So what is this pay system? The pay system is established by the Income Tax Act. It is legally enforceable. And of course, the withholding of tax by your client, the employer, must comply with this system. And under this system, tax is to be withheld by the employer from any payment they make of employment income to the employee. Pay as you earn. You only pay as you earn. So as they earn, as they receive the payment, they pay the tax. That's how it works. The obligation to withhold tax from employment income has priority. So you have to make sure your client knows that the obligation to withhold tax from employment income has priority over any other amount that is to be deducted or withheld from that payment. So before you pay the employee, the first thing you ask yourself, the employers who are here, before you pay the employee, the first thing you ask is, how much is the tax? Okay? And don't do it to impress the employees that we shall not deduct the tax or we shall find a way. No. If you are supposed to deduct tax from the payment, you have to deduct it. That's the law. And it takes priority, meaning that the obligation to withhold tax under the Act overrides any law in force in Uganda that forbids the reduction or attachment of employment income. So that's why these banks, before they attach your salary on a specific loan, they must recognize the taxes first. So before before your employees mortgage their salary to the bank, they must cater for the taxes. The taxman must be paid first. So the obligation to withhold tax under the Act overrides any law in force that forbids the reduction or attachment of employment income. Payee withholding for the year of income is effectively a final tax on the employee's income for that year of income, provided the employee does not have any other forms of income. So the payee that is deducted is final. The payment is not subject to any other tax. as long as the payee has been what? Deducted. The payee return. So we are going to prepare the return today. Okay? We shall prepare the return so that we are sure of the steps. So we are saying that the pay return submission, each employer is required to file both monthly and annual payee returns. You see that? Each employer is required to file both monthly and annual pay returns. Monthly returns of pay are submitted by the 15th day of the following month. For instance, the pay return for the month of January 2024 must be filed by the 15th of February 2024. The taxpayer can use the e-tax system for filing these returns. We are going to be seeing that. If an employee has one employment and his or her employer has duly submitted the pay returns, one employment, you see that? One employment, not multiple. We are going to see the multiple case. If you are employed by one person, one company, and the company, your boss has duly submitted the pay returns and remitted the correct, you also have to verify, is it the correct? How much did you? So tomorrow is Monday. Go to your bosses and ask them, how much tax did you remit? Was it correct? We are going, you recalculate. Okay? You recalculate and see, did they remit the correct? If that is the case, then he or she is not obliged to submit a return of income. You know, by law, we are all supposed to file a return. All of us. As long as you have a tax identification number, you're supposed to submit a return of your income. Now, these are the cases that you don't need to submit. If your boss has submitted, you have one employment, the correct tax has been deducted and paid. If your boss has paid less tax, instruct your boss to remove more money from the next month's salary. Otherwise, if you don't do that, you are doing a disservice to the government. You see that kind of thing? Where an employee has multiple. Now, let's look at the multiple. Assuming I have gigs. I have a gig here, a gig there. I'm also employed there. What is the case? What is my case? Here we are saying that where an employee has multiple employment sources, gigs, or other sources of income from business or property, you have rentals, you have apartments, you have invested in MTN shares, you have shares in Airtel, you know, that kind of thing. Multiple sources of income. Then that means that you as the employee, you're required to file an annual return of income. You are required to file an annual return of income. So if you have been looking for clients elsewhere, you're looking for big companies, business people, even the person near you, it could be your husband, it could be your sister, it could be your brother who has an apartment, who has rentals, who has invested in very many places. He has a kiosk of mobile money. He has Uber business. That is the first client. Because by law, that person there, your neighbor, is required to file an annual return of income. The tax deducted under the payee scheme will be credited against the total liability to get the net tax due. You know, friends, where we are going is going to be very tough. Already, there is a certain scheme URA is promoting or pushing or implementing of uh, tracking down these consultants. You see, most of us are working as consultants. You hire me, I come as a consultant, but I don't pay taxes because URA, in terms of capacity, they don't have the capacity to chase around. But they are fine, they are closing the gap. And the information I have right now is that most of us consultants are on what they call tension. We are on tension because URA is now tracking us. It is tracking, saying, ha, Innocent is a consultant here, a consultant there, a consultant there. But when we look at his tax identification number, when we look at his ledger, nothing. Only the taxes that have been remitted by his primary employer are appearing. So where is this other money? So URA is trying to now track, and that is an opportunity, for you, the tax consultants. Now consultants are going to be looking for you. Now we are going to be having, on top of a personal doctor, then you have a personal mentor, then you have a personal lawyer. We shall need the personal tax consultants. The way it is in developed countries, that's why in developed countries, people have personal tax consultants. Okay? Yes, people to handle their taxes. So position yourselves, members. Position people who are smart, people who want to be straight, whatever they do, they will hire you to manage their taxes. Okay? As long as you do it the right way. Rates of tax. So what are these rates? On this slide that I'm going to share with you after the training, you'll be able to see these rates. Now, the rates are applicable for resident individuals or employees, non-resident. We may not go through this line by line. You will take your time. Take your time and look at the rates. Take your time and look at the rates. So we have the first table for the resident individuals and the second table for the non-resident individuals. And that now brings in the issue of resident, non-resident. But before we understand resident, non-resident, let's talk about secondary, primary employment. As I've mentioned, we can have multiple sources. One person is employed almost everywhere. This company, the other company, the other company. So that is multiple. The rates are going to vary. So you'll find an additional slide which on which you're going to find the rates. And in the first bullet, we are saying that if an employee earns chargeable income less than or equal to 10 million per month from secondary employment, I'm going to define secondary employment. 30% tax rate is applied on the chargeable income. So if you are into secondary, if I get to know if I'm your employer, if I'm your secondary employer, even if you hide from me that, me, I don't have anywhere else, it's the place. If I get to know, then I'm going to apply 30%. If an employee earns chargeable income more than 10 million per month from secondary employment, the rate is 40%. These charges apply to both resident and non-resident taxpayers. Okay. So it looks like we need to clearly understand who is resident and who is non-resident as we are preparing the return. As you're preparing the return, you must do it the right way. Who is resident, who is non-resident? So in this discussion, there are 3 tests that we make. The first test is to ask yourself, does the employee have a permanent home in Uganda? Does this employee have a permanent home in Uganda? If the answer is yes, then that employee is outrightly a resident employee. And you must use the right rates from the other tables I've just displayed. If they don't have a permanent home, of course, the question, what is a permanent home? Permanent home. Permanent home can mean anything. Can mean a rental where you're renting. It can mean a hotel room. Some of you are very, some of you, by the way, there are people who just reside in a hotel. That's it. Someone resides in a hotel. So it could be your hotel room. It could mean a house you've constructed in your name, a bungalow, as long as you have that place of residence, it's available to you. There is a decided case where the ruling was even someone in a cave, because we have some tribes in Uganda who reside in caves. And there is a ruling, There is a ruling that I will be sharing with you that case. The judges brought it out that permanent home can also refer to a cave for tribes that stay in caves. Now, if that test fails, you conduct the second test. Was the employee present in Uganda for a period or periods amounting in total to 183 days or more? Meaning that even 183 days is inclusive, or more during the year under consideration. If the answer is yes, of course, how would you know? The clocking. Hey, has the person been clocking in? You look at the attendance, 183 days. Then that is a resident employee. That's it. If that test fails, we conduct the last one. You may have to go back 3 years. Was the employee present in Uganda for any period during the year of income under consideration, and in the 2 preceding years of income, the period averaging more than 122 days for 3 years? If the answer is yes, then you're handling a resident employee. Now I'm going to paint a more clearer picture with this activity, assuming that we have 2 citizens of South Africa, Okello and Okumu. They are working with Uganda Airlines. They visited Uganda in 2022, 2024. How would we handle the issue of resident, non-resident? Now, let us begin with 2022. You are filing the return of 2022. You have these 2 guys among the people you're going to include in the return. Who is resident, who is non-resident? 2022. Share with me in the chat. First of all, look at it. Look at the other 3 tests. Share with me in the chat. Who would you consider resident for the year 2022? All right, in the chat, Simba talks about Okello, Farouk Okello, Christine Okello, Mohammed Okello, Nancy Okello. Okay. Yes. Okello is considered to be resident for the year 2022 because he makes the 183 days. Okumu is just 1 day shy to the 183 days. Just 1 day shy. So the numbers matter. Let us go to 2023. Let us go to 2023. 2023, who would you consider resident employee? If you are handling Uganda Airlines payroll, you're filing the return, you're the guy in charge, who of these 2 would you consider resident employee 2023? Share with me in the chat. Okay. So I think everybody's saying none, none in the chat. I can see none. Correct. They don't make the 183 days as per our test. Okay, let's go to 2024. 2024, who is resident? Now here they have made the 3 years. We are going to first of all add. Let's first of all add the number of days in total. Let's go for Okelo. How many days are these? How many days on Okelo? $369. So divide by 3. Divide by 3. 2024 is 0. 123. So if we divide by 3, Okelo is 120. Have you rounded off? 123 days. Okay, that's okay. 123 days. Now let us add for Okumu and divide by 3. Okumu divide by 3. Share with me in the chat. Okumu divide by 3. Add, divide by 3. These are average. Okay, we are getting the average. We are getting the average. So we are having 122.3. 122.3 days. 122.3 days for Okumu. So the test, the criteria is 122. I think both of them, they all exceed the 122. So now my question is, who do you consider to be resident? Who do you consider to be resident for the year 2024? Okay. Someone is saying Okumu. Both. In the chat, I have Okumu and both. Now, it is only Okumu who is resident. Reason is that Okelo has not stepped into Uganda. Maybe he doesn't have work. It is only Okumu that is resident. Reason is that Okelo was never present in the year 2024. Okay? So this is the aspect of accuracy I was talking about. As a tax agent, tax consultant, tax employee, you must be as accurate as possible. Now we are going to say an individual or employee must be physically present in Uganda to be considered a resident for that year of income. An individual must be physically present in Uganda to be considered a resident for that year of income. And then number 2, if an individual has a permanent home in Uganda and physically appears in Uganda, even for a single day, they are deemed to be resident for that year. The other category of clients that are going to come to you are these guys that are leaving Uganda to work in outside countries. You're going to get those ones. As long as you position yourself, you're going to get people coming in your inbox with inquiries. I am leaving Uganda. I have got employment in Canada. I am leaving Uganda. I have got employment in the US. I am leaving Uganda. I have got employment in United Arab Emirates, UAE. Now we have so many going there. What is the tax implication of my going to Uganda? I mean, of my leaving Uganda, going to UAE to work, Canada to work. What is the tax implication? Those questions are going to come to you. You'll have friends who are living Uganda and they know you're a tax consultant, you're a tax agent. They want that advice. Of course, I charge. Of course, if you want information and I want me to arrange your affairs, I will charge you. You can charge. You're free to charge. As tax consultants, you charge consultancy. Anybody coming in your inbox, you must charge them. It's like going to the clinic and you're not feeling well. You're having some back pain and you're consulting. Does the doctor give you free consultancy? Do you get free consultancy? You pay for it. So people are going to come to you. Now, starting today, you must have those invoices. So if someone is saying, I have had you're a tax agent, you're a tax consultant, I want this advice, you tell them, let me send you an invoice. Then you send me a what? Yes, that is another way of earning as a tax agent. So don't give free tax. Now, the scenario I'm putting before you, and I want an answer from each one of you next Sunday. You have a client, you have a friend, you have a neighbor. This person is leaving Uganda for Canada. They have managed to apply in Canada. They have received their appointment. They are ready to leave. What is the tax implication of their leaving Uganda to work in Canada? Tax implication in what sense? In the money they are going to earn in Canada with a permanent home. Assuming I don't sell my house. I have my house in Mukono. I have my house in Intinda. And I'm leaving. I'm going to Canada. I have my house in Iguru. Eh? I don't want to sell the house. What is the tax implication on the money I'm going to earn in Canada? Number one. Number two, I have my house in Uganda and I want to leave Uganda totally. I'm selling everything, my vehicle, my house, my small plots of land. I'm going to, I'll come in Uganda as and when. I don't want to do with Uganda anymore. I'm selling my house. I'm leaving for Canada. Give me the tax advice. So those are the two advisory notes I need from you. Next Sunday, each one of you will tell me. I'll share. I'll share the answer booklet. You type in your answers. If I'm leaving for Canada and I'm selling my house, what's the tax implication? Will URA look for me? Will they hunt me down? Huh? Will they hunt me down? If I don't sell my house, I keep it. Maybe I let my other siblings, whatever, stay in it. I go to Canada, I do my work. I keep on coming. Will URA hunt me down? What is the tax implication? So I want you to go and we discuss that because that's another area. I have had more than 5 people asking me this. Okay, asking me this, and being a teacher, me, I just give you information. Please don't fail to consult me thinking I'm going to ask for. No, I'm not going to. As long as you are in my class, you're not going to pay for that advisory. But if you're outside the class, there are some people maybe who, uh, you know, want the complete assessment, and those ones I charge them that you give me the assessment. I have my house, I'm going to earn this. Then they send you the appointment in Canada, maybe you look at it, then you give them the real position. This is what's going to happen. So to position yourself, not, whatever you do, you must think about the tax man. They can disorganize you, by the way. They can disorganize you anytime. So the scenarios are two. I am going to Canada. I have gotten employment in Canada. I don't want to sell my house. What is the tax implication? Will you hunt me down? I'm going to Canada. The second situation. I'm going to Canada. I'm selling everything. My car, my house, everything. I'm going with my family. Everything. I'm leaving Uganda totally. But I might come back because my mother and my father are in Uganda. So most likely I might come back. Will URA disturb me when I'm visiting my mother, my father? What's the tax implication? We are going to discuss that. Okay. We are going to discuss that next time we meet on Sunday. So let's just continue to the next. Having looked at all those scenarios,